Welcome, everybody. Thank you so much for joining us today. Al Jacobson, our executive director, will be joining us in a few moments, and I just wanted to thank him for joining us today. Before we begin today, I would love to introduce Diane Wittry to you. You probably all know and love her. She is the Allentown Symphony Orchestra's music director and conductor, currently in her 27th season. We've asked Diane to say a few words.
Hello, everybody. I'm so glad that you're all on this very, very interesting call. I looked through the slides, and this is going to be a fantastic presentation. So as Lori said, I'm in either my 27th or my 28th. I'm challenged with math, but I've been here quite a while, and I feel that we've really made a huge difference in the Allentown community, in the Lehigh Valley, and so proud of being involved with that. So you may be aware we have three very large anniversaries coming up. We have the 25th anniversary of the shot competition, which is the competition that I helped found, I think in my second year here. We have, after that, the following year, the 125th anniversary of Miller Symphony Hall, which I think is pretty phenomenal. It's one of the last halls standing in the area. All the other ones were torn down. There were, I think, 16 different theaters and concert halls in the area earlier. And then the 75th anniversary of the Allentown Symphony Orchestra, as well as it will be my 30th year as music director. So some things to really celebrate. And then we will be celebrating in this time period, the 15th year of our El Sistema Lehigh Valley music program for students. So a lot of things going on, a lot of things to celebrate. And things like the Schott brothers, who left a trust that enabled us to do the shot competition. And I think of the impact that that competition has had on the region, and also for putting our name out in a larger basis across the country and supporting these young rising artists. So I want you to thoughtfully consider, as you do your estate planning, what type of difference you want to make and how you want to be remembered, and to really realize that the Allentown Symphony and Miller Symphony Hall is an organization that has the capacity to make those dreams come true and to really change the face of the community. And I feel very proud to be associated with it, to work with Al and to work with Jeff and this wonderful staff, and Lucy and Lori. And then we have great board members. So the presentation you're going to hear from Dave and Judy is just going to be phenomenal. So I'm happy to be here and happy to be involved with the Allentown Symphony Orchestra.
Thank you so much, Diane. I appreciate that. We all appreciate that. So today we have two of Lehigh Valley's top experts in estate and financial planning here to discuss orchestrating an excellent estate plan. Judith Harris is an estate planning and tax attorney and an equity member and chair of the Estate Trust and Tax Group at Norris McLaughlin in Allentown. She has more than 30 years of experience in the areas of taxation, wills and trusts, and estate administration. Judith creates estate plans for her clients that include wills, revocable trusts, powers of attorney, and living wills. Her practice also includes the creation and representation of charitable trusts and foundations. Judith works with clients to structure the optimal transfer for a client's wealth and business interests with minimal tax consequences. She has served on the Allentown Symphony Association board since 1993 as an officer and also as a director. David Osborn is Senior Vice President and Financial Advisor with the Osborn Group at Morgan Stanley. David has more than 36 years of experience in financial services. He joined Morgan Stanley in 2021 after spending 25 years with Merrill Lynch. David helps clients build long-term investment strategies. He also helps families and business owners focus on their wealth transfer, philanthropic, and succession planning goals. David has one of those unique combinations of experience in training in both estate planning and working closely with attorneys and accountants to develop customized strategies. David is also a director on the Allentown Symphony Association board and is a past board president. Today's presentation will go for about 35 to 45 minutes. As I mentioned, we'll take an additional 30 minutes after the presentation to answer any questions you may have. If you have questions, please email me, Lori Davis, or text me. And as I mentioned at the start, I will email everyone who registered a copy of these slides. So if you did not register or you're using a link that someone shared with you, please just send me an email and I'll make sure you get a copy. With that, I will now hand things over to Judith Harris.
Thank you, Lori, and good morning to each of you. I'm thrilled to see your smiling faces and thank you for your participation. Lori, thank you for that introduction. Maestro Wittry, thank you for the wonderful celebration and history, these milestones coming up. As a board member, I couldn't be more proud of each of you and the Symphony and the Hall and all that it offers to this jewel of a Lehigh Valley in which we live. Thank you for participating today. Dave is a good friend and a valued professional in this area with whom I've worked closely for several decades, and I feel very blessed to do so. We have many mutual clients and, collaborate whenever possible because we know that we're stronger as a team when we can do that and serve our clients better. Today, we hope to impart some wisdom and clarity on you. You all might already know a whole lot about your own estate plan and the world in which we're living right now, both legally and tax-wise. We welcome questions. I often tell clients, and I see some of you here today, I view estate planning and tax planning as high-level housekeeping. And, we should ask ourselves periodically, is our financial and estate house in order? So today we'll be talking briefly on the elements of an excellent estate plan, the current environment in which we're living, both legally and tax-wise, how you can work to attain your charitable goals, and how others might help you in that regard. What constitutes purposeful wealth planning? And again, we will welcome questions and answers in the fashion that Lori has described at the beginning of this program. So what are the elements of an excellent estate plan? First, understanding your current financial information. Many of you know, and I know we have an estate planning packet that Lori can provide you with if she has not already done so. We often start the estate planning exercise ideally by asking you to give us information regarding you, your family, and the assets that you own, assets and liabilities. We find that estate planning cannot be done effectively in a vacuum. It has to focus on the assets that you own, the form of ownership. Do you own your assets individually or jointly with right of survivorship, as tenants in common, in a partnership, in an LLC, in a corporation or other entity? What are the values of your assets? What is your single largest asset? What are your most important assets from which you live comfortably? What are your liabilities and how are they structured? And a very important consideration in all of this, as we gather information from you about your assets, which are those assets which will pass according to your will at your death, and which of your assets will pass in another fashion? The first category, as you may know, we call probate assets, because they pass through your will as part of the probate process. That's not an evil thing, it's just the way things work. I know there are some people who we see these late night commercials on TV about why probate is evil and how we should avoid it. And there really is not a whole lot of truth in that. It has more to do with state laws, different states' laws, and maybe taxation and some other expenses, but we can talk about that later. The assets that pass outside of your will, we call non-probate assets. Classic examples of those are annuities, retirement plans, or certain other contractual assets, sometimes life insurance, depending upon who or what you've named as beneficiary. And again, those non-probate assets are usually assets that pass according to a beneficiary designation, a separate document or form that you've completed with the custodian of that annuity, retirement plan, or life insurance. Another element of an excellent estate plan is to identify your current personal objectives. In my almost 36 years of doing this, I will tell you that the most prominent observation I've made is we tend to be living longer as a population, thanks to science and modern medicine. And so we're living longer lives, and as such, there is a greater possibility that one or more of us will experience a period of disability or incapacity, either temporary or permanent, at some point in our lifetime. So we would be very wise to consider, as part of our estate planning, consider our objectives with regard to our lives, our lifetime, in the event we become incapacitated, as well as what happens at our death. So we ask ourselves, who should be making these decisions for us, either financially or medically, while we're still alive, if we can't make them ourselves? Who will be the decision maker and manager of our assets and our estate or trust, any trust we create at our death? Whom do we want to inherit our assets at our death? Have we done proper tax planning as part of this estate planning process? Will there be available funds to pay the necessary taxes, whether they be death taxes or income taxes, after we die? And do we have charitable goals? And how do we make certain that those objectives, those charitable wishes of ours, are carried out in the way we want, both during our lifetime and at our death? Have we adequately planned within the context of charitable gifts? Have we made sure that we're going to get the best, the biggest benefit tax-wise in fulfilling our charitable wishes? The basic documents that are usually an important part of each person's estate plan consist of a will, or if you prefer, many of my clients prefer to have, rather than have the will be the center sole document of their dispositive wishes at their death, they like the idea of a will, or a nickname we call that is a pour-over will, in conjunction with a living trust or revocable trust. And based on what you own and what your objectives are, it's pretty easy to recommend which might serve you better in that context. A financial and legal power of attorney, a document that gives us your wishes and appoints people to act, an agent to act on your behalf. If you are either out of the country, unavailable to handle something, or God forbid, incapacitated, who will handle those matters for you? That's defined by a financial power of attorney document. Similarly, for medical decision-making, whether it be routine or end-of-life medical decision-making, we have good laws in Pennsylvania, and we would each be wise to have a medical power of attorney combined with a living will as part of our estate plan. In addition, the law permits you to have formal or informal instructions to your family and other fiduciaries, whether they be executors, trustees, guardians, what have you, as to your burial wishes and tangible personal property. Where do you want your tangibles to go, whether they be an automobile, an art collection, a music collection, jewelry, tools, furniture, collectibles, that sort of thing. So we have all kinds of tools to components of a good estate plan, and some of them are necessary and others are there for the taking if you need them. Tax considerations should always be a part of your estate planning process. And this is a good opportunity to save money, so more assets can go to your loved ones and to organizations that are important to you, rather than to a taxing authority or a government. We have a death tax in Pennsylvania. Not every state does. We call that death tax an inheritance tax. It applies at one's death. There are some important exemptions, and there are different tax rates depending upon the relationship of the beneficiary to you. If charitable gifts are structured properly, the rate of tax will be 0%, meaning they'll be exempt. We have a federal gift tax. We have a federal estate tax. There's a big change scheduled for the federal estate tax on January 1st of 2026. I'm happy to answer any questions later, but it is planned within the law, barring any further changes by Congress before then. And the estate and gift taxes federally are aligned. They work together, they're structured together. We can talk more about them as needed. And we always have income taxes federal, PA, and other states have certain other kinds of taxes. So to minimize tax consequences within your estate plan, we are very wise to go through the steps we've mentioned already, identifying assets, liabilities, how you own things, what your personal objectives are, what your current estate planning documents say, whether the proper tax clauses are included in your will and any trusts you create. And then strategy 2, to look at further the second level of tax planning. What can we do to minimize income and other taxes for you now and as part of your estate plan? And do you have charitable wishes? Because there's, as you will see, and you probably already know, there are several different ways to effectuate your charitable objectives with gifts and bequests, and each one has a different tax benefit or implication. Many of us believe perhaps the most overlooked estate and tax planning asset is your retirement plan. And I'll just take a moment before I turn the program over to Dave Osborn. Retirement plans is an umbrella term. It can refer to an IRA, whether it's a traditional IRA or a rollover IRA that you rolled over from a qualified retirement plan, perhaps as part of your employment. So it includes IRAs. It includes qualified retirement plans, such as the term retirement plans includes a qualified retirement plans, a 401k, a 403b. So we're using the term retirement plans very generally in this program, as we often do in estate planning and tax law. Dave?
Thank you, Judy. Good morning, everybody. It's a pleasure to be here. I thought of an old quote while Judy was speaking, and I could be wrong. I'm thinking it might have been Mark Twain, who said something to the effect that I'm very proud to be able to pay taxes in America as an American citizen, but I could be just as proud of paying less taxes. So some of the strategies that Judy's been talking about and that we touch on, or I will touch on, are designed not only to meet clients' wishes in terms of passing their assets to their heirs and or their charitable interests, but also on a tax efficient basis. In 2019, Congress passed the Secure Act. And among other items in the act, many of you might be aware of this, the age for beginning required distributions from IRAs and other retirement plans was increased to age 72. Another interesting outcome of the Secure Act was the elimination of what we used to call the stretch IRAs. IRAs inherited after 2019 must now be distributed within 10 years. Another unknown fact of that, and if anybody fell under this by inheriting an IRA from somebody other than your spouse, originally it was assumed that there were no required distributions during that 10-year period. And if none were taken through those 10 years, the final 10th year, the full amount needed to come out. Now that in most cases is not a beneficial tax strategy, because that lump sum gets added to all of the other income, because as we know, IRAs are all pre-tax money and will be taxed upon withdrawals. The IRS came out with some proposed regulations in the beginning of this year, and they haven't finalized them, so we're acting under those proposed regulations, that they do require minimum distributions under the old single life expectancy for beneficiaries withdrawals during the first 9 years, with the balance, which would still be a large balance, in the 10th year. Most of the clients that I'm working with that fell under this, we've agreed, except maybe one situation that had a unique income tax implication, we're taking it out equally, pretty much over 10 years in 10% increments. Let's review 4 examples of what we consider to be very tax efficient strategies for your planned giving. We can donate directly from your IRA. I'll touch on that in a moment. An often overlooked strategy that I talk a lot about, and Judy and I have spoken a lot about it with mutual clients, is naming the charity as a beneficiary of a retirement plan. Because I'm in the financial services business, I have accounts such as IRAs and Roth IRAs and rollovers, etc. We'll talk about that. Donating appreciated stock. I'm sure that's not a surprise to many of you, but it's an often overlooked strategy. And then a strategy called a charitable swap we'll touch on, which is also something that is very often overlooked. So as I mentioned, IRA owners now at 72 plus need to take minimum distributions, which, as we know, are reported as taxable income on top of any other taxable income that you have. The Secure Act kind of separated the ages. They did not increase the age of this next strategy that we refer to as a qualified charitable distribution, where anybody over 70 and a half, which used to be the required beginning date, can donate up to $100,000 directly to one or more charities. Now it's key, it needs to be direct. And we in the financial services world have specific forms to get the directions directly from the IRA owner. The money needs to be sent directly to the organization or organizations. And if done properly, it is totally tax-free. There is no Form 1099-R that comes out or that needs to be reported. And you might think, well, my donations are always tax deductible, but there's a very large difference between a direct distribution under this rule and taking an IRA distribution normally, paying taxes on it, and then taking an income tax deduction under itemized deductions for a charitable contribution. It's not the same. This new rule, that's why it's in place, is a much more tax efficient way. It used to be an annual rule that would expire at the end of each year. We lived with that. I don't remember how many years that was, but finally a few years ago or a couple of years ago, they made that a permanent rule. That's probably one of the most efficient ways that I know of to make charitable contributions. So talking about naming a charity or charities as a beneficiary is a very simple strategy. With us, we just sign another form or e-sign, as we do more often now, to name a IRA or something similar as a beneficiary of your account. It's really easy to do with us. It most likely or might not require any changes to your will, but you always need to check with your attorney and make sure it's coordinated properly. But it's relatively simple. And the reason I like it and our clients like it is with IRAs, you can separate your IRA, which is a big nest egg of pre-tax money, into multiple accounts. And I'm guessing many of you have done that. And you can move money, transfer money freely between one of your IRAs to another. So you can manage how much money you have in a specific IRA to control how much is going to go to that specific organization or organizations. So it's really flexible. It does not generally require going back to your attorney and having amendments done to your wills or trusts. So we like that strategy an awful lot. And of course, doing that, you're avoiding passing along a tax burden to your heirs, which, as we know, even though they may have to take it out within 10 years under the new rules, it's still going to be fully taxable. Another strategy that some of you might be familiar with, many people don't think of it because they just are used to writing checks to their charity or charitable interests, is to donate stock. As you may or may not know, a lot of people own stock that might be worth let's not chuckle about today's environment, but might be worth more than what they originally paid for. That's generally the goal of owning stock. When you sell a stock, you incur a capital gains tax. Depending on how long you've held it, you pay a different tax rate. But assuming you held it for more than a year, it qualifies for favorable long-term capital gains treatment. But for example, some of our clients that had accumulated stock through their employer at very low cost over their working years end up with significant amounts of employer stock with very, very low, what we call cost basis, that if they sold that stock, they would incur a very large capital gain. So instead of writing a check to a charitable organization, we advise clients very often to transfer their stock directly, and every organization like the Allentown Symphony Association has a brokerage account to accept that stock, because it can be done directly from one brokerage firm to another with the right instructions, and transfer that stock at the full market value and get a full fair market value tax deduction for that, instead of selling the stock and paying capital gains and then writing a check out of their checking account. Here's an example, and we may be using some high numbers, so forgive me, but understand that you can move that comma to the left and make that $100,000 $10,000, or you can move the commas or the decimal point and assume $1 million. So just for example, assuming somebody wrote a check for $100,000 to an organization such as the Symphony or any organization of your choice, and assuming today's maximum income tax bracket of 37%, you get an income tax deduction of $37,000, which is a net cost to you for that $100,000 donation of $63,000. Now, if you did the same $100,000 donation of market value of stock, $100,000 worth of a stock or stocks, you still get a $37,000 fair market value tax deduction. And a way to look at it is, if you had sold that stock instead under the, say, inefficient strategy, and let's assume you only had a $10,000 cost basis on a $100,000 stock, $90,000 of capital gains with long-term capital gains maximum rate, federal and then state, and a small Medicare surtax that's in place right now. You'd be saving $24,000, or a net cost of $38,800 versus a net cost of $63,000. So it's just maybe an extreme example, but it is a possible example of the leverage or benefit of donating stock. I mentioned before what we refer to as a charitable swap. So let's assume the same person that holds significant appreciated stock, let's say from their employer, that they're still very proud of. They worked 35 years there, and they still have a lot of faith in that publicly traded company. They may even be retired, and they don't want to sell the stock. They want to hold it, but it's the only asset they might have available, or at least it's more efficient than cash, of making a donation. So they can still donate the stock. So same $100,000, for example, stock, they can transfer to a charitable entity and then take the cash that they would otherwise have gifted and repurchase the stock. So what did they do? Let's assume it's the same stock that they had a $10,000 cost basis on a $100,000 value. They make that gift. They avoided the capital gains of $90,000. They take cash and purchase $100,000 of that same stock, because again, they feel they want to continue to own that stock long-term. Now they have a cost basis of $100,000. And if they sell it in 2 years for $150,000, they've saved significant taxes on what would have been a much larger capital gain had they not done this strategy. So it's a free tax benefit that's offered out there that very often is overlooked. And here's a little diagram of how that would look. I don't think I need to go through it. But it kind of is a visual of how that would actually work. And you can, in your mind, replace the proverbial ABC stock that we use in our industry and replace it with anything that you can think of. PPL, AAPL, anything in your mind.
Thank you, Dave. That was wonderfully explained. Very, very helpful. Thank you. So given all this, this knowledge, this information we've been talking about, these opportunities to plan, how can you achieve your charitable goals? Well, just a few thoughts. And before I forget, I'll just make one comment. We're talking about a lot about best practices and things you can do or perhaps should do. I'm going to give you one do not do. There aren't many nevers or always in life, but one of them in the world of estate planning is, and I'll repeat it after I say it, you never want to name your estate as the designated beneficiary of an IRA or qualified retirement plan. I'll repeat that. You never want to name your estate as the designated beneficiary of your retirement plan. Don't ever assume that you can do that and that your will already has charitable bequests in there, and I'll make sure the charity's taken care of because I've named my estate as the beneficiary. This is what keeps people like me and Dave awake at night. I've had maybe 3 instances in my 36 years where clients, I didn't do their estate plans, but unfortunately they passed away and I was asked to handle their estates. And one of them was fairly recent, and the single largest asset of this decedent was an IRA. It was of significant value. And apparently the advice she understood from her attorney was that she should name her estate as the beneficiary of her IRA. And it's just, it's so unfortunate. It was totally unnecessary. And it's led to a lot more complexity to her estate, but more importantly, many, many thousands of dollars unnecessarily going to the federal and PA government, where they could have gone to charities or her loved ones.
Excuse me,
So
Judy, can I add to that?
Yes, please.
So I'm glad you brought that up, Judy. On our end, the financial services firm, when we have, and I've had it happen, and again, I will reiterate what Judy said, never ever name your estate the beneficiary of a retirement plan. I've lived through it, and it creates, not that it's the individual's concern or the account owner's concern, but it creates a tremendous amount of work on our end, which translates into delays, sometimes as long as 2 years, 3 years. I've lived through where, if you can imagine, in one of the examples I can remember is somebody who did not have children, but they had an awful lot of nieces, nephews, cousins they wanted to take care of. So like Judy's example, they named their IRA one of their largest assets in their estate. They named the estate the beneficiary with, I'm gonna make this up, but it was somewhere around 12 to 15 beneficiaries. You can imagine what it was like to try to track down those beneficiaries and get everybody across the country to sign appropriate paperwork after we worked through the attorney and it flowed through, and all these disclaimers and waivers that had to be done.
Thank you, Dave. The proper thing that in the situation I described, and perhaps as Dave described, had proper planning be done, the charities, the loved ones could have all been included in a beneficiary designation, submitted to the custodian of the plan as a separate document. It should not have relied on the will. So thank you for hearing us out. It's so clear in this world that should never be done. And I thought it was worth mentioning. A 501c3 organization, as you know, is a nonprofit organization, a charitable organization that qualifies under the federal tax code and hopefully under state law as well to operate as a tax exempt organization. Most of these 501c3s need to apply for this. Most religious organizations do not. They are per se recognized as such. But I can tell you as a board member of the Allentown Symphony, scrupulous compliance and attention is given to our 501c3 status from the time it was applied for in the 1950s to the 990, the tax returns that are filed scrupulously every year. You want to make sure that, the organizations you're giving to during your life and at death have followed all the rules and maintain their 501c3 status with IRS. For what purpose? With what kind of restrictions or no restrictions do you want to attach to your charitable gifts during your life or bequests at your death? It's important for you to let your estate planners know this. I want this to be used, this gift to be used only for this fund, for the shot competition, or for endowment. Do you want it to go into a designated pool of funds that the Symphony and other organizations have established to make sure it's part of a pool that generates income or growth each year, and the growth is what is used for the organization rather than the actual principal? You have many choices on what kind of gift you want to make, how it should be restricted, or whether you want it to be used for the general purposes of the organization, which is fine. Everybody seems to have different ideas, which is great. Similarly, we've had clients who create separate funds, which I'll talk about in a moment, with for instance, the Lehigh Valley Community Foundation that can benefit the Symphony. I've had the pleasure of serving as legal counsel to the Century Fund for several years. The foundation created by Donald Miller from his estate and from gifts he made during his life, Donald Miller of the Morning Call, who died in 1996. The Century Fund has done great things for many organizations, including the Symphony, but the Century Fund has over the years established funds with the Community Foundation that can benefit organizations such as the Symphony. What if an organization merges with another organization or goes out of existence? We see this all around us from time to time, and we can either put restrictions in the document. Maybe it's okay. I have plenty of clients who say, I want, X amount to go to this organization or its successor, if it should ever reform or merge. Or some people say, if X organization should ever cease to exist, I want the funds to go to another specific organization. So you have all kinds of choices you can make when you plan your charitable gifts. Here are some options for these lifetime gifts that I was referring to. Obviously, one of the beauties of making a lifetime gift to charity is you can see that the good it's doing during your lifetime. Bequests are great too, but you won't have the benefit. Maybe your successors, your heirs will see the benefit of what you've done. But the benefit of lifetime gifts, you get to see the good it's doing for the organization. Those can be cash gifts. They can be charitable gift annuities, which are their own separate kind of gift that you don't have to administer it yourself. That's done by another organization. And many organizations enable these. You just plan the gift and give the money to the custodian, who will see that the organization, the charity, benefits from this periodically. As Dave said, the gifts of appreciated assets, really, really wise, because a 501c3 organization does not typically pay income tax on income derived from its charitable purposes. So a gift of appreciated asset is a way of steering this taxable gain to an organization that will never have to pay. If it's playing its cards right, will never have to pay income tax on that. And you won't have to pay income tax on it either. Charitable trusts. Many of my clients ask me to create and help them administer charitable remainder trusts, whether they be charitable remainder annuity trusts or those are called CRATs, or charitable remainder unit trusts called CRUTs, or charitable lead trusts where the charity gets the stream of payments for a period of years and then the remainder goes to maybe a family. So those are what we call split interest trust or charitable trusts. Retirement plan distributions, which Dave has so eloquently described, can do a lot of good for the organization and help you too. And donor advised funds, typically set up through maybe a community foundation or certain wealth management firms. Once you give the funds to this donor advised fund to benefit a charity or charities, you no longer own them. Those funds are on the books of the organization that's the custodian, but you become the advisor or an advisor who during your lifetime will describe how you would like the funds used, and the decisions will be made based largely, but not exclusively, upon your advice. So we have many arrows in our quiver to make sure that your charitable wishes are effectuated exactly as you want them. So again, we can make bequests to charities in your will or any trust you can create. Those bequests can be of cash, of stock, securities, tangibles. Sure, I've had clients give valuable tangibles to organizations, which can either keep them because they're meaningful to the organization, or can sell them if the gift is unrestricted, sell them at hopefully no taxable gain to the organization, and the organization can benefit from it. So those can be bequests under your will or trust, or as Dave described, designating a charity as the beneficiary of a retirement plan, whether it be an IRA, a 401k, or a 403b, designate a charity as a beneficiary of an annuity or life insurance. Lots of options you have. Going up 30,000 feet and looking at the big picture. We know the estate planning process is important. We know it's high-level housekeeping that everyone should have, and it's an opportunity to identify your personal objectives and to organize and carefully consider the interrelated parts of your family's financial life. I recommend you work with an estate attorney and financial planner, and also your CPA, your accountant. To the extent you use a CPA, I would suggest that your planning is always strongest when you involve the whole team. Keep everybody in the loop, listen to the thoughts of each of your team members, your professionals, so they can all work together to help you. Also, a well-organized plan is flexible and well communicated. One of my longtime valued clients put on his calendar today to sit down with each of his children and describe to them while he's well and can communicate all of this. He's going through each one of his estate planning documents with his children today. That doesn't mean you have to disclose your wishes to all of your heirs during your lifetime. That's your choice. But we like to make sure that part of the planning process is that we help you avoid any unfavorable surprises. And some of those are making sure you have flexibility in your plan. And to the extent you want to communicate your wishes to your advisors and also your heirs, you have the opportunity to do that. Thank you.
Dave, did you have one more thing you wanted to add before we get into questions?
Yeah, I did. Thank you. I wanted to touch on something Judy said just a second ago, as well as a little bit earlier, to emphasize about the coordination piece with the whole advisory team for clients or for individuals, among their attorney, their CPA certainly, and people like myself. All too often, I have found out a year, 2 years later, that a client has revised their estate. They visit an estate attorney without my knowledge, which is their prerogative. However, some of the items that were prepared and recommended from the attorney never got communicated to us. Even though the attorney hopefully told the individual to make sure you contact your brokerage firm, your bank, to make sure that all the titling is exactly as we just agreed upon in your estate plans, that the beneficiary designations are properly coordinated with everything we just talked about in your estate plan. And the lack of coordination can really mess up everything that was just done from the estate attorney, such as Judy. Now, that never happens with Judy's clients and mine, because we work together on that. But something else that is very important, that if you do not have this on your bank accounts or your brokerage accounts or online accounts, if you do not have a power of attorney, either what I call an outside power of attorney from your attorney that it was drafted, or what we call an inside, which is in my case a Morgan Stanley power of attorney document that we have. If you don't have that on your accounts, make that a item for a New Year's resolution. Especially in this context where we're talking about charitable giving, I cannot have a spouse of a client call me and say, Bob just asked me to call you and he wants to make a gift out of his IRA through this qualified charitable donation concept. But he's out of town, but he asked me to take care of that for him. I'll look on the account and I'll say, and I might have to come back and say, I'm sorry, Mary, but I don't have power of attorney on the account for you. And I can't take any instructions. I can't even talk to you about the account. Now, they may have paid 2 years ago an attorney to draft this really nice financial power of attorney, but it was never presented to me. So that's a checklist that you should all make sure you have taken care of. Thanks, Lori.
That's great. Thank you, David. Okay, so I want to get into some questions. If you have questions and you haven't sent them in the chat or emailed me or texted me, please take an opportunity to do that now. And we'll start with the first one. There's a couple questions about recording. I did record this presentation and I'm going to continue to record it. I don't know if it's going to be available on demand because I don't know how to facilitate that, but if I can, I will. I can probably send you a link to it so you can watch it in the future, but we have recorded it in any way possible. I will make it available to you. Okay, so one of the questions is, on a Roth IRA, the beneficiary does not pay tax on withdrawals. Is that correct? Does the withdrawal period, an annual period, quote in parentheses possible, requirement apply as well for a rollover IRA?
I believe that's for me. So can you read the let's go to the second part, the rollover. Say that again.
Does the withdrawal period, an annual period requirement apply as well for a rollover IRA?
Yes. A rollover IRA actually becomes treated the same as a traditional IRA. Once that say it came from a profit sharing plan or a 401k, once it becomes a rollover IRA, it's treated the same as a traditional IRA for our purposes. And for that question specifically, falls under the same required minimum distribution rules beginning at age 72, falls under the same Secure Act changes for inherited rollover IRAs. So I hope that answers that question. The question on the Roth, thank you for bringing that up, whoever that was, because I failed to refer to that. Inherited Roth, first of all, Roth IRAs, as you may, hopefully many of you may know, are after-tax money. They were not deductible, they're after-tax money, but once they that money went into a Roth, they grew tax deferred, which is the benefit. And the other benefit is, since they were funded with after-tax money or non-deductible, when the withdrawals take place, they come out tax-free as long as they were held for 5 years. Now, there are no required minimum distributions during a Roth IRA owner's lifetime. So you do not have to take minimum distributions, but upon death, even the previous rules, there are required distributions for Roth IRAs. Hopefully that answers that question. But they still are tax-free. They just have to be withdrawn for the beneficiaries have to take them out as for an inherited Roth under the single lifetime distribution tables. Excuse me. Post 2019, the Roths fall under the 10-year rule now. However, those proposed regulations for having to take minimum distributions in the first 9 years do not apply to the Roth. Excuse me. Hope that helps.
A charitable gift from a rollover IRA. I am told that the financial organization will send out a 1099-R form to you at the year end, showing the total amount of removal of funds from the IRA, even a portion that goes to a charity.
Yes, I think I tried to correct myself. I mentioned that the benefit is there's no 1099-R. It does go out, but it does identify that it is a non-taxable. There's a box on there that refers to it as being a charitable direct distribution.
Okay.
Lori, I see a question on the chat. Do you see that?
Are you talking where?
Can you donate with personal tax benefit to a nonprofit that just started and is not yet a 501c3?
Oh, yes, I haven't gotten to that one. Yes, go ahead.
Oh, I'm sorry. Do you mind? Shall we
No,
deal
go
with
ahead.
this?
Yeah.
Okay. That's an excellent question. And I'm going to answer that with a question, which is, has the application for recognition of tax exempt status been filed yet with IRS? What the law says is, so I want to make a donation to an organization that has not yet been recognized officially by IRS as a 501c3 organization. Should I go ahead and make and it's December, so I'd love to have the tax deduction this year, but is this too risky? And my answer is this. I would ask whether the organization has filed the what we call a Form 1023. It's a very, very involved application for tax exempt status that you submit with all of the requisite legal documents attached to it with IRS. The law generally says, the regulations, that you could make if the application, let's say the application was submitted last week on December 1st. And I will tell you, in this environment, as somebody who deals with IRS every day of my life, professional life, it can take several months, if not over a year, especially during COVID, for IRS to review and or approve a 1023 application, because many times they come back at you as the attorney asking questions. We need more information before we can rule on this. So if I submitted the application for tax exempt recognition to IRS on December 1st, and I still, let's say you made a kind of perhaps, anticipatory contribution this year to try to get the deduction, and we didn't hear from IRS until next June, which is a possibility, and they approved it. The law says that the approval date relates back to the day of application. So you're taking a chance by making the contribution before actual tax exempt status was recognized. But if all goes according to plan and it's approved, even if it's approved in June of 2023, the approval date, the official exemption date, will relate back to December 1st. If however, at the time you made the contribution, the organization had not yet submitted its 1023 to IRS. I would absolutely suggest to you, unless it's a church or a religious organization and we have other information, I would advise against making that gift. Or I would find another way to do it, maybe through a donor advised fund with a community found. You know, there are other ways we could engineer your getting the deduction in a way that might work out, but it's a little more complicated. I hope that answers your question. Thank you.
That's a great point about donor advised funds. They've become so popular in recent years because you may need to take an immediate tax deduction, but you don't know necessarily who you want to give that money to yet. And so donor advised funds help serve that purpose. It not only does it do that, you can put it into an account and it'll grow for you, so you have more charitable funds to give away at a future date. So and donor advised funds have become so I don't know, so popular with people. Many custodians or many sponsoring organizations have eliminated a minimum contribution to a donor advised fund. So it's really open to most people if you want to open one. Okay, so another question: if your assets are in a trust upon death, is the trust considered a part of the estate, or is it more like a financial vehicle with beneficiaries like life insurance?
Oh, great question. Dave, shall I take that? Okay.
Definitely.
Okay. Typical lawyer answer, it depends. And the reason it depends is this. There are two parts to the answer to your question, and it's a great question. Okay, so let's say you created a trust during your lifetime and you put $100,000 in it, and you drew from that during your life. And the way you wrote the trust, let's say the trust was revocable during your lifetime, and the moment you died, you could no longer revoke it, so it became an irrevocable trust. Okay, so the question, the very good question is the 100,000 in this trust, is it part of your estate or is it something else? And there are two answers to the question. The easy answer is that basket of assets, that trust, which you can't change anymore because you've passed away, those funds are supposed to pass to whomever or whatever you have named as beneficiaries in that trust. So the language of the trust document will govern what's supposed to happen to those funds. There could be charities in there, the Symphony could be mentioned, your children, your spouse, all kinds of possibilities, but your trustee has to follow the letter of the document. However, there can be interrelated provisions with your estate saying, hey, if my estate owes some death tax and there's not enough money in the estate to pay it, my executor shall ask my trustee for sufficient assets to pay the death taxes. It depends how you and your attorney planned the estate. But generally you have to follow the language of the trust document. But here's a twist in Pennsylvania and other states that have an inheritance tax. And we know we have, the possibility of federal estate tax. It depends how that trust was written and funded during your lifetime as to whether the 100,000 in that trust will be taxable for inheritance tax purposes at your death. If you funded it in such a way that it was an irrevocable trust the moment you created it during your life, and you put funds in that irrevocable trust, never to be able to control them again, I'm 99% sure that your estate will not need to pay death tax on those funds because you parted with them and you parted control with them. Pennsylvania has a 1-year rule. So if you created that irrevocable trust and put the 100,000 in more than a year before you died, Pennsylvania would not tax it for inheritance tax. So the tax implications are where it gets a little detailed. And I hope I've answered your question, but rule 1 is we have to follow what the trust says as to where those assets go.
That's great. Thank you, Judy. Okay, question on the two questions about the charitable swap. How many times can you do a charitable swap with the same account? That's the first question. And then the second question is, if you swap your funds and purchase the same stock again, wouldn't the stock value be less than what you initially when you initially purchased it? So how is that advantageous to buy it back? Maybe buy back a different stock? So tell me if you, Dave, you're probably gonna answer this question, but let me know if you need me to repeat that.
Yeah, I might want you to repeat that, but
Okay.
Go ahead and read it one more time if you
The
don't
first
mind.
part is, how many times can you do a charitable swap with the same account?
Okay, let's stop there. So I can't imagine there's any situation where there's a restriction on that, because you're sending a stock out, you're donating it. It's a totally separate transaction from buying a stock. And not that I have ever come across somebody doing it multiple times in a short amount of time. So as far as I know, and that's something that I would have to defer to a tax advisor, there's no restriction on it. It does not fall, as from my understanding, under any of the rules that we have to be concerned about, called wash sale rules, because you're not selling. And that has to do with losses anyway. Go ahead and read the second part.
If you swap your funds and purchase the same stock again, wouldn't the stock value be less than when you initially purchased it? So how is that advantageous to buy it back?
No, it wouldn't be. Stock value wouldn't be less. Assume you do it at the same time. So what we're talking about is, let's use the example of $100,000 value today of ABC stock, and your cost basis from however you acquired it is only $10,000. So we're avoiding that $90,000 capital gain. You ask a firm like us to transfer that stock to a organization worth $100,000 today, and you today or tomorrow buy that same stock from your advisor, from from your account at it's worth $100,000. It's today's market value. You're gifting at today's price, and you're buying it at today's price. When you're buying it at $100,000, and that's your new cost basis. I hope that answers the question. Judy, did that make sense to you?
Absolutely, Dave. Absolutely.
The last question I have, unless somebody enters another question in the chat room, is what happens in PA when you die without a will?
Thank you so much for having asked that. It occurred to me I didn't cover that in my presentation, and so I'm so glad you asked. The answer is the intestacy laws of Pennsylvania come into play. And those intestacy laws, it's part of the statute of the Probate Estates and Fiduciaries Code in Pennsylvania. It tells you who receives your assets. And if you watch late night TV, they try to tell you that it will all go to the government. I've seen some of those. Don't believe that part, but the state law will dictate where they go. If you are married and don't have children, your assets, and I'm oversimplifying, will basically go to your spouse. If you're married and have children, about half will go to your spouse and half will be divided among your children. It all has to do with the relationship, the familial relationship of people who survive you. Okay, and it's written in the statute, and to the extent somebody has really specific questions, I can answer that offline, walking you through the statute. Similarly, if you, so that's who gets what if there's no will. Here's the other question. Who's the executor, or what we call personal representative, if there's no will? Similarly, the statute in Pennsylvania tells you who in priority order, who the personal representative, what we call executor when there's a will, who will be in charge, the legal representative of your estate if you die without a will. I also wanted to mention, if you don't have because I cannot emphasize enough how important a power of attorney document is, whether it be financial or medical, you really should have both. In some respects, I think it's the most important legal document there is in the world when you think of what can be done with it and what can't be done with it. For people who never got around to creating a power of attorney document and becoming incapacitated, God forbid, the thing to do is we have to go to court. I had a proceeding this week, but it had more to do with a disability than of a younger person than an older person. You have to go into guardianship court, into the Orphans Court Division of the county court system, and apply for guardianship. Have somebody petition the court to be appointed guardian. There are two parts to that process. First of all, getting a doctor's report that we submit officially to the court, and the court reviews, saying this person is no longer capable of handling financial or legal matters or medical decision making, and then petitioning, Your Honor, I'm the person, whoever it might be in your family or friends, I'm the person who should be appointed to do these things. So it would be a whole lot easier and less expensive. And we would be sure your wishes would be carried out if you have a power of attorney document, so we don't have to go into guardianship court. So that's why a will is so important. A power of attorney is so important. Thank you for that great question.
If I might add, that also creates a nightmare for us on our end in the financial services world, because the decedent's accounts are totally frozen until all of that is resolved that Judy just referred to. If there is no personal, other than an IRA that has a beneficiary, but they still have to have a personal representative to give us instructions.
Well, that's all the questions that we have for today. I have put up everyone's contact information. If you have additional questions, please feel free to reach out to any of us. We are all happy to help. Thank you so much for joining us for our call today. It's been a pleasure having you and learning more. And again, if you have questions, please reach out. Otherwise, take care and happy holidays.